Deutsche Bank is in crisis mode right now as it is being flushed down the toilet. You came here for the truth, so let me unveil that for you. Let's look at this today, trying to explain exactly what's going on with Deutsche Bank and how critical they are to the global financial system. This will be a quick video. I just want to go through the very basics. Global debt climbs towards fresh high as companies and countries keep on borrowing. And this is the type of activity we've been seeing. This has been obvious. We've covered it here many times before. How companies and countries have accumulated more debt since the financial crisis. They're supposed to be deleveraging, getting rid of all of that, but it's impossible. And as a result, these corporations have taken on more debt and more risk since the financial crisis in order to get themselves out of the mess, only digging themselves deeper. One of those institutions is Deutsche Bank. This is out of the New York Times. These are cyclically European banks, and then there are cyclically European banks, and then there is Deutsche Bank. Shares of the German banking giant, like those of a number of its peers in Europe, have swooned over the last years as investors reject banking models that only rely on volatile market activities as opposed to collecting deposits or managing investor accounts. Now, they are suggesting what the fundamentals would, and that is, look, people want safety and security. They want banks to make money off of those little bits of interest payments and accumulate money that way. However, you're trying to create derivatives and you're trying to create all of these credit default swaps and everything else and trying to profit that way, and they don't like it. That's how you and I think. But the markets, the algorithms that are looking for those little bits of fractional income we're not seeing eye to eye on that at all. So the article, of course, what do you expect from the New York Times? You have to sort of read between the lines. The latest turbulence came on Monday. Shares of Deutsche Bank touched new lows after the German magazine reported that Berlin had ruled out providing government aid to Deutsche Bank. So they have been rumblings and mumblings here about does Deutsche Bank need a bailout? Would there be a bail-in and others? Let's move on. The question of assistance arose after a disclosure by the bank last week that the United States Justice Department, as an opening position, was seeking $14 billion of penalties as a result of its investigation. That sum is equal to the bank's market capitalization, which now stands at just $14 billion. But you look at the amount of Deutsche Bank's derivative exposure, and you will see something that is drastically higher, something that is just ridiculous for the amount of market cap that this country or this corporation has. The spokesman said that a government bailout was not on the agenda, and added Deutsche Bank is determined to meet the challenges on its own. Despite the denial, speculation abound that Deutsche Bank will again be forced to ask investors for more cash at a moment of extreme weakness. So are they getting a bailout, or will this be a bail-in? And I think that's exactly where they are going. They are not getting a bailout. It will be a bail-in. And this would be the biggest news in years. It would explain a lot of what's coming down the pipe, because we can see how different countries, Cyprus number one, had initially drawn up these plans. They activated them, and then Brisbane, Australia, to all my friends out there in Australia, you saw exactly firsthand what the G20 was going to do. And they said that they would implement bail-ins. The bail-in regime is going live. This right here could be the first major example of that. And then you look at this, which is the derivative exposure. Now, it's a little bit outdated. This is from the end of 2015. Not sure what it's at now. But essentially what we're looking at is derivative exposure being $42 trillion for one bank. So they have a fraction of that in their market cap, and yet they are able to hold and control $42 trillion. This isn't too far off from the total GDP of the entire world, which is fake anyway. But the total GDP of the entire world, they could crash the entire global economy should this fall. Now, they are going to use the excuse too big to fail, except they're not going to use a bailout. They're going to use the bail-ins. Fed to force JPMorgan, Citi, Bank of America, and other top banks to hold more capital. So all of this chaos that's happening with all the banks, all the institutions, they are saying, you know what? We have a big problem on our hands. And you guys, we need to hold more capital. And instead of 3% of reserves, you're going to have to hold 3.5%. Or something silly to that nature. And that's what we deal with every day. We see this silliness that they say you have to hold more capital, and the fraction that they're holding is ridiculous. They have nothing. They're holding on to nothing, but yet again, we have to listen to it all. If you found this video informative, please give me a thumbs up. Last but not least, if you found the video informative, I know you'll find my book, The Money GPS, even more informative. Head over to Amazon, flip through the book for yourself. Take care.